Margaret was 73, recently retired, and proud of the $620,000 she had built in her traditional IRA over 35 years. She thought the hard part was over, but then a letter arrived from the IRS, a penalty notice for missing something called a required minimum distribution. She had no idea it even existed. That mistake cost her over $4,000 in penalties alone. Today, we're going to make sure that never happens to you. We're breaking down exactly what RMDs are, when they kick in, how to calculate them, and smart strategies to soften the tax blow.
So, what exactly is a required minimum distribution, or RMD? Simply put, it's the minimum amount the IRS requires you to withdraw from certain retirement accounts each year once you reach a specific age. Here's the logic behind it. Accounts like traditional IRAs and 401ks are funded with pre-tax dollars. You got a tax break when you put the money in. The government eventually wants its cut. That's what RMDs are. They force distributions so the IRS can collect income tax on that money. The accounts affected include traditional IRAs, rollover IRAs, SEP IRAs, simple IRAs, and most employer plans like 401ks and 403bs. Notably, Roth IRAs are exempt because you already paid tax on those contributions.
This is exactly the rule that caught Margaret off guard. The SEC 2.0 Act, passed in December 2022, changed the starting age for RMDs. If you were born between 1951 and 1959, your RMDs begin at age 73. If you were born in 1960 or later, you get a little more runway. Your RMDs don't begin until age 75. Here's a critical detail. Your very first RMD has a special deadline. You have until April 1st of the year following the year you turn the required age. But, and this matters, every subsequent RMD must be taken by December 31st of that calendar year. Miss either deadline, and the IRS is not forgiving. All other years have a hard December 31st cutoff.
Here's something most people don't realize. Your RMD amount isn't fixed. It actually changes every single year. This chart shows how RMD withdrawals grow as a percentage of your account balance as you age. The IRS uses what's called the Uniform Lifetime Table, a life expectancy factor that shrinks each year, meaning a larger portion of your account must be withdrawn. For someone with a $500,000 IRA at age 73, the RMD is roughly $18,900. By age 85, that same account, if it stayed flat, would require a withdrawal of nearly $37,700. This is why proactive planning matters. Margaret's account was growing, which made each year's required withdrawal even larger.
The math behind RMDs is actually simpler than it sounds. Here's the formula. Take your account balance as of December 31st of the prior year, then divide it by your life expectancy factor from the IRS Uniform Lifetime Table. For example, at age 73, the life expectancy factor is 26.5. So if Margaret's IRA was worth $500,000 at the end of last year, her RMD would be $500,000 divided by 26.5. That's about $18,868. Now here's an important rule. If you have multiple IRAs, you calculate each one separately, but you can take the total combined RMD from just one account. With 401ks, it's different. Each plan requires its own separate withdrawal. This is a common confusion that trips people up.
Here's the number that makes every financial advisor cringe: 25%. That's the IRS penalty on any amount you fail to withdraw from your RMD. Before 2023, it was actually 50%. The Secure 2.0 Act reduced it, but 25% is still brutal. If Margaret's RMD was $18,868 and she missed it entirely, she'd owe a $4,717 penalty on top of income taxes when she finally withdrew. The good news? If you catch the mistake quickly and take corrective action, the penalty can drop to just 10%. But the best move, the one we're here to help you make, is to never miss it in the first place.
This is the chart that changes how people think about RMDs. The blue line shows the growth of a $500,000 IRA invested in a broad index fund, assuming historical average returns of around 7% annually. The orange line shows the same account after mandatory RMD withdrawals and taxes at a 22% effective rate. The gap between those two lines, that's the real cost of deferred taxation over time. By age 85, the after-tax, after-RMD balance could be nearly $200,000 less than the gross figure. This is why smart planning, like Roth conversions before RMDs kick in, can make a massive difference. We'll cover that strategy in a moment.
Once Margaret understood the problem, she wanted to know, is there anything I can do? Absolutely. Let's walk through 4 smart strategies. First, Roth conversions. If you're in your 60s and not yet at RMD age, converting some traditional IRA money to a Roth IRA reduces your future RMD balance. Roth accounts have no RMDs. Second, Qualified Charitable Distributions, or QCDs. If you're charitably inclined and at least 70 and a half, you can donate up to $105,000 per year directly from your IRA to charity. That amount counts towards your RMD, but is excluded from your taxable income. Third, if you're still working, you can delay RMDs from your current employer's 401k. And fourth, you don't have to spend your RMD. You can reinvest it in a taxable brokerage account.
Here's a topic that surprises a lot of families: inherited IRAs. Before 2020, non-spouse beneficiaries, like a child inheriting a parent's IRA, could stretch withdrawals over their own lifetime. The Secure Act eliminated that. Now, most non-spouse heirs must fully empty the inherited IRA within 10 years of the original owner's death. And depending on whether the original owner had started their RMDs, annual distributions within those 10 years may also be required. Spouses still have more flexibility. They can treat the inherited IRA as their own or delay RMDs based on their own age. The rules here are complex, and the IRS has been updating guidance. So if you've recently inherited an IRA, this is an area where consulting a financial advisor is especially important.
After learning about qualified charitable distributions, Margaret, who had been donating $12,000 a year to her local food bank, made one simple change. Instead of writing a check from her bank account, she directed that $12,000 directly from her IRA to the charity. That $12,000 counted toward her RMD, never appeared on her taxable income, and she got the full benefit. The IRS allows up to $105,000 per year in QCDs for those 70 and a half or older. For someone in the 22% tax bracket, directing $12,000 through a QCD saves roughly $2,640 in federal income taxes alone. It's one of the most underused strategies in retirement planning.
Margaret's story didn't end with that IRS penalty letter. Once she understood the system, she worked with a financial advisor to set up automatic annual withdrawals, converted a portion of her IRA to a Roth over 3 years, and began directing her charitable giving through QCDs. She turned a stressful situation into a solid plan. Here's what we covered today. RMDs are mandatory withdrawals from tax-deferred accounts, starting at age 73 or 75 depending on your birth year. Missing them triggers a 25% penalty. The calculation uses your prior year balance and an IRS life expectancy factor. And there are real strategies, Roth conversions, QCDs, reinvesting, that can reduce the tax impact. If you found this helpful, subscribe to US Wealth Logic. New videos every week.
This video is for educational purposes only and does not constitute financial advice. Tax laws and IRS rules can change. Always verify current guidance and consult a licensed financial advisor or tax professional before making decisions about your retirement.